Today, we're talking about adjustable rate mortgages. I decided on this topic because my oldest son, who is already a homeowner, was talking to a friend of his that lives in Texas that just bought a home and got a 4.625 interest rate. And of course, my son was like, "How did you get that rate in this market?" His friend told him that it's a 3-year ARM. So my son called me to ask, what is an ARM? So I immediately thought this would be a great teaching moment and something to talk about on my YouTube channel. So anyone that's halfway alert knows the interest rates are up and buyers are looking for options and lenders are looking for options as well to keep people borrowing to purchase homes. So with that, we're seeing a jump in adjustable rate mortgage loans. So I explained to my son, and I'm going to go over that with you as well. Well, the name itself gives us a big clue. The interest rate will adjust at some point. Now, I don't know the specifics of the friend's loan, other than the fact that it's a 3-year ARM, but that's okay. ARMs come in different options. You may have a 3-1 ARM, you may have a 5-1 ARM, you may have a 7-1, 7-3, and that means that the interest rate is fixed for the first number. So if it's a 3-1 ARM, then your first 3 years is a fixed rate. The second number represents the frequency or how often the rate will adjust. So if it's a 1, then it will adjust annually or once a year after that first fixed rate term. Now, there are some out there that will adjust every 6 months. Like I said, there are different options. So now, adjustable rate mortgages have taken a lot of flack or heat as being bad products in the past, but we have to remember that everyone's situation is not the same. What may work or be advantageous for one person may not work for you. So an adjustable rate mortgage, in my opinion, will work or be advantageous for a person that knows that they are selling or that they can absolutely refinance before the new higher rate kicks in. And let me just sidestep for a moment and briefly talk about refinancing. You also need to consider the cost of refinancing to determine if it's the best choice for you, because it may cost you more in the long run to refinance. Now, I do understand that sometimes people make the decision to pay more in the long run or later just to be able to take advantage of home ownership at the initial lower monthly cost. And then also in regards to refinancing, understand that lenders require a certain amount of equity in a home in order to refinance. So be sure that you're buying in an area that is going to appreciate at a rate that will allow you to refinance. Also, your credit and employment needs to be stable in order to refinance. So just understand that refinancing is not a guarantee. Now, back to the adjustable rate mortgage. Now, how do you know what your new interest rate will be? Well, you don't know exactly because it depends on outside factors such as the U.S. Treasury rate or the LIBOR, but you will know what the maximum percent is that it can adjust by at each interval. And you should also know what the lifetime cap is, which is the highest that the interest rate will ever increase to. Now, the Truth in Lending Act requires lenders to disclose this information to you. And oftentimes you receive disclosures, but you don't read them in detail or ask questions. Please be sure that you're reading the disclosures. Please be sure that you're asking questions so that you understand your best and worst case scenario. You need to know what's the maximum amount that your payment can increase to and be realistic about your ability to make that payment. Things you want to consider are, will you be taking on any additional sizable debt? Maybe a car payment or school tuition? Is your income going to increase, and how often will it increase, and by how much? Is your employment stable? Now, we talk about, so what's the advantage to an adjustable rate mortgage? One is that lower initial monthly payment. Number two, you may be able to qualify easier because your debt to income ratio will be lower because of the lower monthly payment and the lower, which is, a factor of the lower interest rate. Thirdly, is you may qualify for more home because again, you got a lower interest rate, lower monthly payment, which then allows you to qualify for more money. Now, the con for adjustable rate mortgages is that they're super risky because we can't predict the future. We don't know what interest rates are going to do. So you could find yourself in a position where your monthly payment, because of the spike in interest rates, is significantly higher than it would have been had you chosen to go with a fixed rate loan product. So this is the skinny on adjustable rate mortgages. I hope that this information will help you to feel more confident in analyzing this type of loan product and determining what is the best route for you. I appreciate you watching the video. If you have not subscribed to my channel, I ask you to please do so. Also, click the bell so that you'll be notified when the next video comes out. If you have questions, put those in the comments. And if there's something you'd like to see me do other videos about, put that in the comments as well. I will definitely take that into consideration. Again, thanks for watching. Have an amazing day, and I appreciate your support.